Good morning, sir. I'm Priyanshu Singh Chauhan. My roll number is 20201 BBA0170. This is our second assignment where we were supposed to prepare a Picha PPT on flotation cost and a weightage average cost of capital. The first page is about the introduction, uh, weightage average cost of capital. Uh, a capital called the weightage average cost of capital is used to calculate the average after-tax cost of capital from all sources, including bond. It can be bond, common stocks, preferred stocks, or other type of debt. Management does not control it; the external market does. Like the income sources are controllable by the market. The more sales the company does, the more income it can get. Weightage average cost of capital is calculated by combining the blended cost of capital from all sources such as debt, preferred shares, and common stock. Researchers, investors, and firm management can all benefit from this, and its formula each uses it for a different reason. Finding a company's cost of capital is important in corporate finance for a few reasons. For few reasons, for not just for few reasons, but for many reasons. For illustration, a corporation might calculate its net present value using the weightage average cost, discount rate, etc. If the management expects a lesser return than what is investors are anticipating, they will want to use their money more wisely. They won't be investing in the company. Researchers, investors, and firm management can all be benefit from this. So it is a crucial when assigning the advantages of taking a new initiative. For instance, a merger is probably a return greater than its cost of capital. It helps to analyze the researchers about the company. So now I will go to the flotation cost. Cost incurred by the corporation or institution while issuing new securities are also known as flotation cost. Several charges such as underwriting, legal registration, and audit fees are example of possible costs. The cost of flotation is calculated as a percentage of issue price. Let's go to the calculation. The First we will see the how we can calculate the W weightage average cost. It calculated by multiplying the cost of each capital sources, which can be debt or equity or both, by its relevant weight, and then adding the product together. In the above formula, uh, it represents the EVE divided by V represent the proportion of equity-based financing, while the D divided by V in the second part, D divided by V, it represents the proportion of debt-based financing. So in this formula, E is equal to market value of the firm's equity, D is equal to market value of the debt equity, V is equal to E plus T. Means V representing the sum of both market value of equity and market value of debt. RE is equal to cost of equity. RD is equal to cost of debt, and TC is equal to tax rate, corporate tax rate. So the WACC, मतलब weighted average cost, is calculated by multiplying the cost of each capital sources. The this formula involves it basically involves the sum of two terms, which is E divided by V into RE, the first one, and the second one D divided by V multiply RD multiply 1 minus TC, मतलब tax rate. So here is one example how we can calculate the cost, weightage average cost. In this example, we can see like a company obtained a 1 million in debt financing and 4 million in financing, equity financing by selling common stock. So E divided by V would be is equal to 8.8 and D divided by V is equal to zero point 0.2. We can also do the same calculation over the Excel. What does the VACC, weightage average cost of capital, means? So the high weightage capital means it is more expensive for a company to issue additional share of equity or to raise fund. High weightage average calculation often means a company is more risky to invest in as investor and creditors. Both demands higher return in exchange for higher risk incurred. So the calculation of flotation cost is here. It has four basic terms. The RE, cost of equity. D1, dividends per share 1 year after, per share dividend received after 1 year. PO is equal to current share price, and G is equal to growth rate of dividend. So, however, the insurance of new share cause the company to incur flotation expenses. Thus, the current share price denoted as must be adjusted for the effect of such cost. In this formula, it shows like one more term, which is 1 minus F. F is here is flotation cost, which must be in percentage. So, nevertheless, the previous approach is not correct because the incorporation of flotation cost does not depict the actual picture. And now we will go to the limitation of both the things, both the methods. So the first is about the limitation of weightage average cost. So the if the researchers or any person is not familiar with all the inputs, it may be a challenging to compute the weightage average cost. Greater depth level imply higher weightage average cost requirement from the investor or company. Calculating weightage average cost become more challenging as balance sheet become more complex and difficult to understand. For as when There are many types of debt with different interest rates. So the weighted average cost is calculated using a variety of variables, including taxes and interest rates, all of which are influenced by market and economic conditions. And also, the weighted average cost is not so suitable for the projects which are associated with the higher level of risk. Limitation of using flotation cost. So, some analysts argue that including flotation cost in a company's cost of equity implies that flotation costs are on uh, um, on an ongoing expense and forever overstates the firm's cost of capital. In reality, a firm pays the flotation cost one time upon issuing new equity. On offset this, some analysts suggest to companies cash flow for flotation cost. Thank you.